Hello friends, a very warm welcome to this session. Today we are going to discuss a topic that is widely known but little understood: financial management. Financial management is a curious term. You cannot manage money, you actually manage the events in relation to its use. As regards the concept of financial management, there are two aspects, namely money controlling and money management. People who are effective in controlling their money allocated to the things that matter most control their financial activities by thinking critically about how they should spend that money and have a clear plan for it. So for these people, financial management is about discipline. It is about execution. It is about making sure that they are not wasting money and that they are indeed following their plan. Financial controlling is the mechanism to monitor and control the direction, allocation, and usage of your financial resources. Managing your money through financial services goes well beyond making a to-do list and learning to say no to reckless spending. It is a skill that requires self-assessment, planning, and continuous discipline, and learning of financial lessons along the way. In this session, you will learn the definition, need, importance, and some significant techniques of financial management. Let's look at them one by one. Important fund-based services include leasing. A lease is taken when a business doesn't have ample fixed capital and at the same time wants to use the asset but doesn't want to pay for it. Hire purchase. This is a method of paying for something in which the buyer pays a part of the cost immediately and then makes small, regular payments until the debt is completely paid off. The buyer can use the product but does not legally own it until all payments are made. Each one of us would have some experience of buying something under a hire purchase scheme. Factoring. Factoring is a financial transaction and a type of debtor finance in which a business sells its accounts receivable, that is invoices, to a third party called a factor at a discount. Accounts receivable financing is a term more accurately used to describe a form of asset-based lending against accounts receivable. Forfeiting. Forfeiting is a means of financing that enables exporters to receive immediate cash by selling their medium and long-term receivables, the amount an importer owes the exporter, at a discount through an intermediary. A forfeiter is typically a bank or a financial firm that specializes in export financing. Mutual funds. A mutual fund is an investment security that enables investors to pool their money together into one professionally managed investment. Mutual funds can invest in stocks, bonds, cash, or a combination of these assets. In simpler terms, mutual funds are like baskets. Bill discounting. Bill discounting is an arrangement whereby the seller recovers an amount of sales bill from the financial intermediaries before it is due. Such intermediaries charge a fee for the service. Credit financing. Alternative titles include borrowing, lending, loan, money lending. Credit, transaction between two parties in which one, the creditor or lender, supplies money, goods, services or securities in return for a promised future payment by the other, the debtor or the borrower. Housing finance brings together complex and multi-sector issues that are driven by constantly changing local features, such as a country's legal environment or culture, economic makeup, regulatory environment, or political system. The purpose of a housing finance system is to provide the funds which home buyers need to purchase their homes. This is a simple objective, and the number of ways in which it can be achieved is limited. Notwithstanding this basic simplicity, in a number of countries, largely as a result of government action, very complicated housing finance systems have been developed. However, the essential feature of any system, that is, the ability to channel the funds of investors to those purchasing their homes, must remain. Venture capital. Venture capital is a form of private equity and a type of financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. Venture capital generally comes from well-off investors, investment banks, and any other financial institutions. However, it does not always take a monetary form. It can also be provided in the form of technical or managerial expertise. Venture capital is typically allocated to small companies with exceptional growth potential, or to companies that have grown quickly and appear poised to continue to expand. Fee-based services. When financial institutions operate in specialized fields to earn income in the form of fees, commission, brokerage, or dividends, it is called a fee-based service. Issue management. An issue is the process of offering securities in order to raise funds from investors. Companies may issue bonds or stocks to investors as a method of financing the business. Portfolio management. Portfolio management is defined as the art and science of making decisions about the investment mix and policy, matching investments to objectives, asset allocation for individuals and institutions, and balancing risk against performance. Corporate counseling. Corporate counseling denotes the advice provided by the merchant banking to the corporate unit to ensure better corporate performance in terms of image building among investors, steady growth through good working, and appreciation in market value of its equity shares. Merchant banking. A merchant bank is historically a bank dealing in commercial loans and investments. In modern usage in the United States, the term additionally has taken on a more narrow meaning and refers to a financial institution providing capital to companies in the form of share ownership instead of loans. Credit rating. Credit rating is an analysis of the credit risks associated with a financial instrument or a financial entity. It is a rating given to a particular entity based on the credentials and the extent to which the financial statements of the entity are sound in terms of borrowing and lending that has been done in the past. Stockbroking. Stockbroking is a service which gives retail and institutional investors the opportunity to buy and sell equities. Stockbrokers will trade shares both on exchange and over the counter, depending on where they can find the best price and liquidity. Capital restructuring. Capital restructuring is a corporate operation that involves changing the mixture of debt and equity in a company's capital structure. It is performed in order to optimize profitability or in response to a crisis like bankruptcy, hostile takeover bid, or changing market conditions. Bank guarantee. A bank guarantee is a type of guarantee from a lending institution. In other words, if the debtor fails to settle a debt, the bank will cover it. A bank guarantee enables the customer or debtor to acquire goods, buy equipment, or draw down a loan. Letter of credit. A letter of credit or credit letter is a letter from a bank guaranteeing that a buyer's payment to a seller will be received on time and for the correct amount. In the event that the buyer is unable to make a payment on the purchase, the bank will be required to cover the full or remaining amount of the purchase. Debt restructuring. Debt restructuring is a process used by companies to avoid the risk of default on existing debt or to take advantage of lower available interest rates. Debt restructuring can be carried out by individuals on the brink of insolvency as well, and by countries that are heading for default on sovereign debt. Types of financial activities. Fund-based activities. Underwriting or investing in shares, debentures, bonds, etc. of new issues, primary market activities. Dealing in secondary market activities. Participating in money market instruments such as discounting bills, treasury bills, and certificate of deposit. Involving in equipment leasing, hire purchase, venture capitals. Dealing in foreign exchange activities. Fee-based activities. Managing the capital issue, stocks or bonds issued by a corporation or government in accordance with the Securities and Exchange Board of India, SEBI guidelines, enabling promoters to market their issue. Making arrangements for placement of capital and debt instruments with investment institutions. Arranging funds from financial institutions for clients' project cost or working capital. Assisting in getting all government and other clearances. Modern activities. Rendering project advisory services right from the preparation of the project report till the raising of funds. Planning for memoranda and articles of association and assisting in their smooth execution. Guiding corporate customers in capital restructuring. Acting as trustees to debenture holders. Recommending changes in managing structure and style. Structuring financial collaboration or joint venture by identifying partners and preparing joint venture agreements. Rehabilitating and restructuring sick companies. Hedging risks by using swaps and other derivative products. Managing the portfolio of large public sector corporations. Undertaking risk management services such as insurance and buyback options. Advising clients. Promoting credit rating agencies. Minimizing cost of debt and determining optimum debt equity ratio. Undertaking capital market services, clearing services, registration and transfers, safe custody of securities, collection of income or securities. Services provided by the financial system. Risk sharing. The financial system provides risk sharing by allowing savers to hold many assets. It also means the system enables individuals to transfer risk. Financial markets can create instruments to transfer risk from savers to borrowers who do not like uncertainty in returns, or payments to savers or investors who are willing to bear the risk. The ability of the financial system to provide risk sharing makes savers more willing to buy borrowers' IOUs or informal documents acknowledging debt. This willingness, in turn, increases borrowers' ability to raise funds in the financial system. Liquidity. The second service that financial system provides for savers and borrowers is liquidity, which is the ease with which an asset can be exchanged for money to purchase other assets or be exchanged for goods and services. Most of the savers view liquidity as a benefit. If individuals need their assets for their own consumption and investment, they can just exchange those assets. Liquid assets allow an individual or firm to respond quickly to new opportunities or unexpected events. Bonds, stocks, or checking accounts are created by financial assets, which are more liquid than cars, machinery, and real estate. Information. The third service provided by the financial system involves the collection and communication of information or facts about borrowers' expectations about returns on financial assets. The first informational role the financial system plays is to gather information. That includes finding out about prospective borrowers and what they will do with borrowed funds. Another problem that exists in most transactions is asymmetric information. This means that borrowers possess information about their opportunities or activities that they do not disclose to lenders or creditors and can take advantage of this information. The second informational role that the financial system plays involves the communication of information. Financial markets do that job by incorporating information into the prices of stocks, bonds, and other financial assets. Savers and borrowers receive the benefits of information from the financial system by looking at asset returns. As long as financial market participants are informed, the information works its way into asset returns and prices. Importance of financial services. It is the presence of financial services that enables a country to improve its economic condition, whereby there is more production in all sectors, leading to economic growth. The benefit of economic growth is reflected on the people in the form of economic prosperity, wherein the individual enjoys a higher standard of living. It is here that financial services enable an individual to acquire or obtain various consumer products through hire purchase. In the process, several financial institutions also earn profits. The presence of these financial institutions promotes investment, production, saving, and so on. Hence, we can summarize the importance of financial services as customer specific. Financial services are usually customer focused. The firms providing these services study the needs of their customers in detail before deciding their financial strategy, giving due regard to costs, liquidity, and maturity considerations. Financial services firms continuously remain in touch with their customers so that they can design products which can cater to the specific needs of their customers. The providers of financial services constantly carry out market surveys so that they can offer new products much ahead of need and impending legislation. Newer technologies are being used to introduce innovative, customer-friendly products and services, which clearly indicate that the concentration of the providers of financial services is on generating firm or customer-specific services. Intangibility. In a highly competitive global environment, brand image is very crucial. Unless the financial institutions providing financial products and services have a good image and enjoy the confidence of their clients, they may not be successful. Thus, institutions have to focus on the quality and innovativeness of their services to build up their credibility. Concomitant. Production of financial services and supply of these services have to be concomitant. Both these functions, namely production of new and innovative financial services and supplying of these services, are to be performed simultaneously. The tendency to perish. Unlike any other service, financial services do tend to perish and hence cannot be stored. They have to be supplied as required by the customers. Hence, financial institutions have to ensure proper synchronization of demand and supply. People-based services. Marketing of financial services has to be people-intensive and hence it's subjected to the variability of performance or quality of service. The personnel in financial services organizations need to be selected on the basis of their suitability and trained properly so that they can perform their activities efficiently and effectively. Market dynamics. Market dynamics depend to a great extent on socio-economic changes such as disposable income, the standard of living, and educational changes related to the various classes of customers. Therefore, financial services have to be constantly redefined and refined, taking into consideration the market dynamics. We hope you found this session helpful. Thank you.